So, welcome to the Tax Talk podcast and the first of a two-part mini-series. I'm here today with Colleen Gillam-Judd. Colleen is a certified financial planner with IG Wealth Management. For over 15 years, she and her team have been creating a space for high-achieving Canadian families to find financial freedom, security, and clarity. Colleen prides herself on clearly presenting financial options in accordance with her clients' goals, while always working to preserve the financial legacy of her clients. Colleen, thank you very much for taking the time out of your schedule to hop on the podcast with me.
Thanks, I'm really looking forward to it.
Perfect. So we've got a real good discussion today on tax-free savings accounts, RRSPs, and non-registered accounts. I know this is a big topic that comes up for a lot of my clients when we sit down to either go over the personal or the corporate returns, and just to kind of put some planning into place, how best to use these accounts, how to keep pushing that wealth ahead, and using the options available to you. So, first question, and I thought this would be kind of a good way to start. Why is it important that people know something about financial planners and planning?
Financial planning is becoming more and more important because we've made finances complicated, right? Now we have, like we're going to talk about today, when do you use what? TFSA, RSP, non-registered. When do we leave money in the business? When do we take it out? How do we take it out? So the financial planning portion is just going, how do we take all these assets that you've accumulated over your lifetime in your business personally and use it to do all the things that you want to do, whether that is go on a vacation, buy a new home, retire one day, kids go to school, weddings, all the good stuff, and also help plan for all of the less fun parts of life. Like if someone gets sick, passes away,
For sure.
we get locked down for 2 years. So that's where financial planning comes in, is to help address all the financial pieces of our lives.
Perfect. No, that makes sense. So kind of off camera before we got into this, we were chatting and you had mentioned, maybe one financial planner is not the same as another financial planner. Is there something that, our client should be watching out for when they're going to, maybe find a new firm to help them with their planning goals?
Yes, in Canada, there's a couple of different things to look at. We've gotten accustomed to, traditionally, you would work with a financial institution like the bank, and you would sit down and talk to someone about your investments. That's not the same necessarily as financial planning. So we have in Canada two main designations for financial planning. There's your Certified Financial Planner, or CFP. That's what I have.
Perfect.
It is a fairly high benchmark for a form of education and exams that you have to do to be able to qualify. It also comes with continuing education that we have to do every year, similar to yourself.
For sure.
On the accounting side. So that is probably the highest mark. That is, if you're a business owner, if things are complicated, that would be where I would say is the place to start. Is you would like, in a perfect world, you want to work with someone that has that level. If you're starting out in your financial career or getting going past post-secondary, you got your first big job,
Sure.
working with someone at the bank or someone that has what they call a PFP, or professional financial planning designation, sort of an entry-level planning designation, is a great place to start as well. We are working towards at IG, and most of the financial planning firms is having most of their staff have that high benchmark of a certified financial planning designation.
Yeah, I guess that would kind of help if someone is approaching a particular firm. They kind of know everybody that's employed here, or is working in conjunction with IG, has that level of experience and education, and that way they can be assured that whoever they're working for and with has got that level of experience to support them, and one person happens to move on. I know that's happened to me in the past, with a particular firm. One individual moves on, and at least you know that you're kind of falling back onto someone else that has a similar experience level.
Yeah, and that's a key part, right? Because life happens. If something,
Sure.
your planner retires, or who knows, to have an institution behind them that someone can come in, will have the right knowledge and skill set to be able to work with you on your finances, and you don't have to be concerned whether or not they know what they're doing. One thing to watch out, as financial scams unfortunately have gotten more prevalent over the years, it's always a good practice, if you are looking for a new advisor or financial planner, to don't be afraid to ask them about their designations or their education level or their experience level. It's a question that I hope that all my prospective people ask. It's something I always bring up because it can be very challenging to know, right? When you're looking at a website or on Instagram, they look like they know what they're talking about, but do they? Are they regulated by anybody for if there's errors, right? Things happen.
Right.
It's always a good question to ask somebody new.
No, good point.
Yeah.
Perfect. So I think we'll get into this next topic. So can you explain to me what is the difference between a tax-free savings account, an RRSP, and a non-registered investment account?
So fun. We make it so easy with all the acronyms.
Oh, yeah.
So we'll start with the easiest one.
Okay.
A non-registered investment account or margin account, however you want to call it, unfortunately they do give it multiple names, is the same as your savings account or your checking account. You can use those funds however you like. It can sit in your checking, like I said, your savings, your business account. It can be invested to buy a GIC, a stock, a mutual fund, doesn't matter.
Okay.
Okay?
Perfect.
That's personal or corporate.
For sure.
RSP has been around the longest in Canada.
Okay.
So, registered retirement savings plan, you have a deduction amount of what you're allowed to put in to your RRSP that you get every year on your notice of assessment based on some math and calculation that they do. But the basics of that is you put your money in, Revenue Canada says, thank you, here's a tax receipt for your contribution to offset on your tax return. But when you go to spend it, you pay.
Correct.
So when you pull money out of your RSP or your RIF, when you retire, you get taxed when the money comes out. A tax-free savings account, you put the money in, you get no tax deduction, but when you take the money out, you don't pay any tax.
Gotcha.
So I like to think of them as opposite things. Your tax-free savings account, you get you get the benefit at the end.
Right.
TFSA, you put money in, no benefit. When you pull it out, you don't pay any tax.
Right.
Your RSP, you put money in, you get your benefit, but you pay later.
Right.
So like everything, would you prefer, depending on the goal, do you need the benefit up front, or can you take it later on down the road?
Right.
So when we look at it from a planning standpoint, a tax-free savings account gives you more flexibility,
Okay.
right? Because when you put the money in, you're essentially using after-tax dollars.
Correct.
You can invest it however it fits for what's going on in your life.
For sure.
When you pull it out, anything that it's made, whether that's dividends, capital gains, interest, you get it all out without having to pay. So you put in $5,000, it grows over the years to $10,000. You take the $10,000 out, you get to put it in your checking account. That's it. You don't have to declare it on your tax return.
For sure.
Easy. Your RSP is for deferral for saving for later, right? You're putting money away for your retirement with the idea that it's at a lower tax bracket down the road.
Right.
So you put in that $10,000 contribution, you get a tax slip you get to use on that year's tax return. And then when you go to spend it 20, 30, 10 years later, whenever that time is,
Sure.
and you pull that $10,000 out, now it is income and taxable.
Gotcha.
So it just We use them at different times for different things, and it is the mix of the non-registered versus the tax-free versus the RSP that now we have all these different levers that we can pull and play with depending on the situation.
Perfect. No, that's really good. I think that's a good explanation as to, some of the uses for both of those registered accounts. And I think there is a lot of confusion in the marketplace as to which one does what. And I think as we kind of get through this conversation, we'll kind of delve into, some of the pros and cons of them, when to use them. I like to kind of go through that with my clients because just because, one, mechanism might work for you right now, it might not work for that same person in a slightly different situation. Or you might get a few years down the road and what made sense to be contributing into at that juncture no longer makes sense because your personal or your business situation is different. So I'm looking forward to kind of delving into that a bit more because I think that's a really important topic for clients to really wrap their minds around.
And the key to it, like you said, is it has to be flexible.
Mm-hmm.
And we have to keep it flexible in our minds, right? Like an RSP 1 year might be the biggest bucket that you put money into.
Right.
And in 2 years, maybe it switches. So knowing that it's going to change when you use a tax-free savings account versus an RSP versus a non-registered should always be dictated based on what's going on in your situation for any given year.
Right.
And it's going to change. That's okay.
Okay.
Yeah.
And it's not, I'm putting into an RSP because my dad did and his dad did and all my family did. It should be because it makes sense for me and my family at this particular point in time.
Absolutely. And I've found, financial planning today looks very different than it did 20 years ago. We don't have the same pension programs that our parents and grandparents had when they were saving for their retirement and futures. Also, retirement looks different.
It's true.
Right? Lots of business owners and entrepreneurs, they're not going to retire the same way. Right? You used to retire at 60 or 65 because your body hurt too much.
Right. Right.
Right? Like now there's lots of people that I plan with people more about what day do you want it to be that you don't have to go to work?
Oh, okay. Gotcha.
When that, flip the switch and it's like, well, now I can go to work just because I want to. And I can stop, I'll be fine. I can stop working tomorrow and I am good to go.
Gotcha.
That is more common now when we're doing financial planning is where do I get to my financial freedom date where I get to decide when I want to, if I want to keep going to work. And then knowing the mix to use these programs to best utilize that.
I like that.
Mm-hmm.
All right, so moving into the next one, and I'm interested to see where this goes. So what is a common myth that people believe about their tax-free savings account?
Oh, it's such a great program with such a bad name. Oh, such a bad name. I wish we could have convinced the federal government when they made it to not call it a tax-free savings account.
Gotcha.
It's been out since 2009, and many people still believe that it has to just go in a savings account because that's what the name implies, right?
I see.
Tax-free savings account.
Gotcha.
And up until very recently, seemed a little futile to put it in a savings account and make no money.
Yes.
With interest
Very
rates
true.
being low,
Very
right?
true.
So they
Very
weren't as highly utilized as they could have been because of the name.
For sure.
So the tax-free savings account is just the name of the program.
Right.
It can be invested in all the same ways your RSP can be.
Gotcha.
So that's the number one sort of myth out there about them is the name is sort of misleading, I would say.
That's a very fair point.
Tax-free savings account. So it doesn't have to be in a savings account. The other one is, because it's been around since 2009, is we work a lot with clients now to pay attention to what is your individual tax-free savings account limit. It's a little different than an RSP, where your limit is based on how much money you make. A tax-free savings account is every Canadian over the age of 18 gets the same contribution limit each year.
Right.
But if you don't contribute that year,
Mhm.
it just carries forward with you.
For sure.
So now we just have to look and make sure that we know each person's individual
Right.
TFSA room so
Sure.
that we can maximize it.
Perfect.
The other nice thing about them is whatever you take out of your tax-free savings account, you can put back the following calendar year.
Correct. Perfect. So I definitely know that is a big concern for a lot of people, because I don't know how many times I'll get a phone call and it's, Jared, I put some money into a mutual fund. Okay. Well, where is the mutual fund in? Did you purchase it through an open account? Is it in an RSP? Is it in your TFSA? Depending on where you purchased this investment, I may care about it for tax purposes this year, or I might not care about it for tax purposes this year. And depending on where you're purchasing it, like we've kind of mentioned, there's pros and cons as to where that money is and where it's working for you, and whether it was beneficial to put those dollars in there, or maybe you should have put it through a different account. So yeah, I think it's very important to iron out those details and have an understanding that within that tax-free savings account, yeah, you could have a savings account, you could have a GIC, but you can have a broad range of stocks that you can put in there. You can have, I think for the most part, basically everything that some of these other accounts do, save for maybe some crypto investments and a couple of other things, if I remember correctly.
The rules are very similar to an RSP.
Okay.
So for simplicity purposes, if you're allowed to put it in your RSP account,
Okay.
you're allowed to put it in your tax-free savings account.
Perfect.
They have lined that up quite nicely
Okay, that's
to
good.
make them fairly equal and to try and make it a little bit simpler.
Sure.
So that's the rule of thumb. Obviously, we can always look up each investment individually, but from a broad range, if you can put it in an RSP, you can put it in your tax-free.
Perfect. Good to know. So you had mentioned that, similarly to the RSPs, there is a bit of a contribution room. Unlike the RSP, which is based on your earned income, the tax-free savings account, you kind of get this additional bump in your contribution limit each year. So is there a simple way that one could go and determine what their room is, say for 2023, if they're wanting to stick a bunch of dollars into that tax-free savings account?
Yes, the simplest way is to go onto your My CRA login.
Okay.
That's going to be the most accurate and the easiest to get into. It might be starting to get easier now to phone, the same way you used to be able to phone to get your RSP limit if you couldn't find it on your notice of assessment.
Okay.
But I have found phoning can feel challenging. So if you have access to it, I would go through the My CRA. That is the simplest and the easiest way to do it.
Perfect.
Yeah.
No, that makes sense. And I guess that kind of leads into the next point. This is maybe a bit of a newer discussion on the tax-free savings account. I know it's cropped up with RSPs for a number of years. Is what happens if you over-contribute? If I'm putting too many dollars and CRA gets wind of this, what's going to happen to me if I put too much money into either or TFSA or RSP?
Right. So CRA doesn't like us to over-contribute to either program, right? None of us like getting that little nasty email or piece of mail in the mailbox.
For sure.
So if you over-contribute to either program, so your tax-free savings account or your RSP, there is a penalty of approximately 1% a month for every dollar of over-contribution. If you are deemed someone that does it all the time, they do have a tendency to increase that. So it is really important, and your accountant and your certified financial planner or whatever investment advisor or financial planner that you're working with, if you walked into my office, for example, and said, Colleen, I want to max out my TFSA, the first question I will ask is, I'm going to need to see your printout, or we need to call my CRA to find out exactly what your limit is, because you don't want to get that notice saying that you've over contributed, whether it's a tax-free or an RSP. The RSP, we've really grown up with that knowledge, don't over contribute. The TFSA, because the amounts are starting to get higher and people are using them more, it is becoming more common for all of us in the industry to start asking if someone wants to max it out. If we haven't been doing your contribution every year, I will always ask, I'd like to see your limit so that you don't accidentally over contribute, just to make sure that we're staying within the guidelines, especially because I found some newer employers are not just doing RSP matching programs now, they're doing tax-free savings account matching programs.
Okay.
So we have to take those contributions into account for your contribution room for the year.
That's
Which,
really
they're a great program, but we don't want to double up
For sure.
accidentally.
For sure. Well, that's a good point. I know from personal experience, if you over contribute to that RSP, there is a very ignorant form that CRA has that you need to complete. And essentially what it does is you have to go through the form to self-assess yourself to determine that penalty that you have to pay, which I find to be really agitating. Typically, if you're late filing or you don't pay, well, they just send you a bill.
Yeah.
Here's the penalty, here's the interest, pay it up, and we'll move on. But this one, you know, it has that extra bit of bite because you got to sit there and work through this form and figure that penalty out yourself. So I would definitely strongly avoid over contributing to both. And, you know, like you mentioned, it is a very simple check. Just to go online, grab that number, and just keep that piece of paper in both of your records.
Yep.
And for whatever reason, you know, CRA comes back and has a problem with it, well, you say, this is what I printed off, this is what I went off of. And, you know, then you've got that knowledge that you're contributing based on what CRA has provided. And, you know, I've seen it too many times that clients just go into that new planner, they say that exact same thing. I want to max out my RSP. And then it comes tax season and they've got a slip for $50,000 and it's like, you're way over contributed. What happened here? Well, I went into this new planner and they said this would be fine. And I said, well, did you not look or did they not look? You didn't think to ask us? And you know, it just creates a lot of unnecessary headache. You know, find that wealth planner that's going to take those particular steps to protect you at the start.
Yes.
Because if you're contributing into something that is beneficial to you, but you're way over contributed, well, we're just going down the wrong road right from the get-go. So.
And it's just such, like you say, those forms, I think they add that little extra hurt in there. So when you do it once, you'll never do it again.
No,
those
I never
forms
need to
are
do them
painful.
again. For sure.
Painful.
Perfect. So now we're kind of getting into maybe the meat and potatoes of the conversation, things that I really think clients can kind of take and apply to their situation and kind of use this knowledge to really grow that wealth, you know, preserve that legacy. So when does it make sense to contribute to that TFSA, the RSP, or that non-registered account?
Right. So let's look at it in 3 different stages.
Sure.
So when you're starting out, right, we'll say, got a young family, you're into your career, you've got the mortgage, you're working a ton,
Sure.
kids are expensive, all that good stuff, right? I'm
Right.
right there, in the middle right now. A tax-free savings account is a really great place to put your emergency fund.
Okay.
That is where I really advocate for, put that 3 months of savings. Put And then anything extra into there can be extra savings for if we get to the end of the year and you happen to, someone in the family worked more overtime than they thought. Well, we can take your tax-free savings account and move some of it over to your RSP, get that RSP contribution.
Sure.
So it works good for that.
Okay.
You have, like we unfortunately had last summer, hail, break your windows, or go through the roof, and while you're waiting for that insurance claim check to come through, we can use the tax-free savings account to fix the house, fix the truck, whatever.
Okay.
Because it's flexible, you can pull money out and there's no penalty.
Right.
So that's a good one.
Okay.
Your RSP, when you're starting out and working, you're going to use that. I recommend using it to where it's the most tax advantageous according to your accountant.
Okay.
Where does it fit so that you get enough tax back that you feel sort of comfortable
Right.
and will start hitting some of those long-term goals of retirement?
Okay.
Okay? And then the non-registered is for saving for a holiday and a vacation, right? You've got extra money, anything that you're going to use it for that you know it will get spent in the next 12 to 18 months,
Okay.
non-registered.
Okay. Gotcha.
As you get further along and say we're 5 years out from maybe that retirement date, the tax-free savings account starting to max that out to help cushion the retirement planning becomes more and more important.
Okay.
Because we want to balance in retirement all those different income streams, right? We're going to be taking money out of the business as a source of wealth, whether depending on how you have structured it with your accountant.
Sure.
We're going to have your government pensions, your CPP and your OAS. We're going to have any money that you saved in your RSP is coming out as a RIF,
Right.
and then that's 100% taxable. And then we have your tax-free savings account over here. That's the extra money that you can have every month or every year that you don't have to declare. Yay, winning. That's
Gotcha.
when they become really beneficial.
Gotcha.
Because as we get older, right, we only have all these pay raises from a tax standpoint after 60.
Right.
Because at 65, between 60 and 70, you're going to start your CPP and your OAS. That's
Right.
taxable.
For sure.
At 71, Revenue Canada says, thank you for playing.
Yep.
Your RSP now will become a RIF.
Mhm.
You have to take money out of that RIF account at 72.
For sure.
It is fully taxable. So we can use the tax-free savings account to add cash flow to do all the fun things you want to do with being able to help keep you in that tax bracket that is
That's a good point.
comfortable.
That's a good point.
It's also a really great place for that next generation and legacy planning.
Okay.
For those families or that group that, you know, helping that next generation or their grandkids 2 generations away,
Okay.
the tax-free savings account becomes a really nice place to do that. Because all of the growth in the account is tax-free, you can pass that along to beneficiaries and they inherit it in Canada tax-free.
Gotcha.
Now, it does roll to the surviving spouse
Right.
and stays sheltered.
Mhm.
So if one spouse passes away, it merges into the surviving spouse's TFSA and continues to grow over time.
Right.
Okay?
Okay.
When that second spouse passes, it will go through the estate or to the beneficiaries, however the will is set out,
Right.
and they receive it tax-free. Like the estate doesn't have to pay tax on the TFSA,
For sure.
but if they don't have TFSA room, the beneficiaries,
Right.
they don't get to have it to continue to grow tax-free.
Okay.
Okay?
Gotcha.
That benefit only happens to the spousal rollover.
Okay. Fair enough.
But I am finding more and more of my clients are using it for generational wealth because they'll save in a tax-free, let it grow, and maybe help grandkids with post-secondary
Sure.
or down payments on a home or whatever, right? Compounding growth over 30 or 40 years, tax-free, adds up,
Yeah. Okay.
especially when you get to take it out and you don't have to
Right.
give any of it to CRA.
Gotcha.
So it's very, very flexible and is becoming a bigger piece of legacy planning every year.
Perfect.
Mm-hmm.
Yeah. So I guess I got a couple of thoughts on that. One of which being maybe from a client's perspective, and then maybe one just from my own personal experience. So I know when I guess got out of high school, I know there was, from whomever I was talking to on the planning side at that point in time, there was a push, put some dollars into an RSP. I think based on my experience since that point in time, I don't necessarily know that that was the best idea for me.
Mm-hmm.
And I guess my reason being is at that juncture in time, my income was in a lower bracket. So yes, there is a bit of a deferral, but probably in the scheme of things, there's never going to be a permanent tax savings because I put the dollars in, say, in the first bracket, and then presumably someday I retire and I eventually get back to that first bracket. There's really no permanent savings.
Mm-hmm.
Beyond that, now I have those dollars tied up in this RSP, whereas I could have probably used some of them for maybe purchasing, a vehicle when it came time. I started a business a few years after I was done high school. Maybe I could have used some of those funds to build that business. And then even when I get into, partnership with the accounting firm, could you put those dollars to better use in the short term if you're maybe holding them on that tax-free savings account and then using that for things, to me, I feel like I can get a better return on my time within the firm than I can in the volatile market right now. Is that something you kind of look at with clients?
Absolutely, because you're right. That traditional way of looking at retirement planning or saving, right? I remember my parents were like, finish school, get that first job, take 15% of your check and put it in an RSP, right? Like, that's what everybody was told. But that's what I mean. Planning for retirement and our version of retirement is going to look and is starting to look very, very different than it was for past generations. No, one's not better than the other, they're just different. Right? I think you're right in saying when we're looking at planning now, or when I'm looking at planning with my clients, we need to build it so that it's tax efficient today, right? That that RSP tax receipt is nice.
Sure.
But we need to make sure there's enough flexibility in there.
Right.
If you are entrepreneurial and going to start a business, well, lots of times an RSP is not going to be the number one place you want to save money because you have all these other places that you can use for tax deductions and write-offs to balance your income. Now, if you're an individual that just has really high employment income, lots of times your RSP is like the only thing you've got.
Yeah.
So that's when it does make sense.
Sure.
But now I would argue it is more common to look at an RSP second than first. Where I think 15 years ago, it was RSP first.
Sure.
And that was one of the reasons, one of the arguments for bringing out the tax-free savings account program, is saving for retirement had started to drop. The rates had started to drop across Canada, and they wanted to bring another program in that was more relevant for today. So it was a good call. Unfortunately, the name was a little confusing for a little while, but we're getting there. But yes, you're right. The tax-free savings account provides all the same benefits from an investment standpoint as an RSP, but with the perk of being extremely flexible. Sometimes the downside to that flexibility is people are a little more prone to not save it for that long-term future event.
That's probably fair.
Right, because one of the perks still for if you put RSP money in, maybe you were more disciplined than I was at 20, but one of the reasons why I never dipped into my RSP when I wanted to go on that trip that I maybe shouldn't have was because I didn't want to pay that tax bill.
Fair enough.
So it did give me a deterrent
Yep.
to
I would
not
agree.
dip into it. So that is beneficial. Will I hopefully ever be at that lowest tax bracket even when I'm in my 70s and 80s? In some ways I really hope I'm not.
That's fair.
So it wasn't, from a tax point of view, maybe the perfect
Right.
way to do it, but sometimes that is still a helpful thing.
For sure.
And before the tax-free savings account came out, the RSP was the place to save for post-secondary for that first house.
Sure.
They've just come up now with better, more flexible vehicles
Right.
that I think need to always be looked at and addressed. For most people, a TFSA will be the first place to contribute. The RSP will maybe be second.
Okay.
Yeah.
That makes sense. So I guess from a client perspective then, so I know a lot of people will come in here, say we're sitting down to go over that year-end file. To me, I like to go through that to a certain extent, but it's all historic information, it's done, it's in the past. I prefer to sit down with clients and kind of ask, what do you got going ahead? What are your big plans? What are we working towards next? And some of these goals, then translate into, well, we need to do a bit of tax planning. We need to talk with the planner. So if a client was to come to you and kind of put some of these ideas ahead, is that something you can kind of work with them to, maybe determine in conjunction maybe with an accountant and say, okay, my client has a business, they're thinking about expanding in the next 3 years. What should we be doing with maybe some of the excess money they have? Is there a way to make things work now, but also kind of plan for that, bit of retirement down the road? Because I guess, you only have so much money, you've got to take a bit now to put it here or put it there. So is that something you kind of help clients out with?
Yes, so one of my favorite part of the job, and one of the most important pieces, is at the beginning going through, I call it the goals and concerns sheet.
Okay.
So what fun things do you want to do over the next 2 years, 5 years, 10 years, and then we go out from there, right? So in your perfect world, when would you like to quit working?
Okay.
Or just quit working as hard as you're working today?
Right.
What things do you have coming up over the next 12 to 18 months? I always start there. What's coming up in the next 12 to 18 months
Okay.
that we need to put money aside for? Because that always needs to be covered off first. And then it's, what's the medium-term plans? What are you doing for the next 2 to 5 years? What's going on with the business? What's going on with the family? What's coming up that's going to take a little bit of time
Sure.
to plan for, right? Because probably in your world, I hope anyways, most people are not coming in and going, guess what, Jared, last week I sold the business. You're going, wait, we needed to talk about this. So, those things we're planning in conjunction with the other professionals in people's world and spheres all the time.
Okay.
Because when we have those major life events, whether it's buying a business, bringing on partners, expanding the business, selling the business, all of that we look at from the financial side, right? What's going to work in the perfect world, and then it's taking it to their accountants and going, okay, this is what we think works. Does it work for what you see on your side?
Right.
Because they need to work together.
Agreed.
And knowing that they're going to change every year. So when we're looking at our financial planning, we use a software system to do it, because then it stays up to date for taxes and inflation and all that fun stuff. It is changeable and accessible all the time.
Okay.
Right? Because that's one of the bigger myths about doing a financial plan or having a financial plan, is it sounds like, yep, got it, done.
Right.
And it is done, but it's going to be reviewed and updated and changed
Right.
at least once a year,
Sure.
probably semi-annually.
Okay.
Because what we are talking about for how should we make the tax-free savings account work versus the RSP versus the non-registered versus the business. Also takes into account when we're talking about legacy is how does that reflect in your estate documents?
Okay.
Do we make sure that all of those pieces match?
Right.
So it is a living document that we are touching on and referring back to all the time. Because the investment choice or the vehicle, whether that is a GIC or a savings account or a mutual fund or a tax-free savings account or an RSP, all doesn't really matter if it doesn't fit with the person's goals,
Right.
right? Because you could get the best rate of return
Mhm.
in an RSP,
Right.
but if you didn't need the RSP to begin with,
What are you doing?
it wasn't as helpful as it should have been.
Right.
So it's always starting with what are the goals? What are we shooting for here
Gotcha.
first? What's the best vehicle, TFSA, RSP, non-reg, to hit that goal?
Okay.
How are we going to fund it so that you can still do fun stuff every day? Have your Starbucks,
Sure.
coach soccer, like all those good things. How do we fund it in a reasonable way?
Okay.
And then what do we put it in the vehicle with the funding is last.
Okay.
And then we take all of it and run it by, especially if it's for self-employed,
Okay. That's a good point.
just to make sure that, like, I don't know all the ins and outs of all the tax implications of doing certain things, so we always want to make sure that that I'm working with and alongside the other professionals, especially for business owners.
Yeah.
That's so important. Or if there is a major retirement package or severance or pension from a corporation, like if you were an employee and you're not
Sure.
anymore, making sure that we're running all those decisions by the accountant as well, because we don't want to do something that makes March of next year
Right.
upsetting for everyone.
No, and that's a good point. Like when you say, this is my investment plan, well, so be it.
Mhm.
But that plan, just like succession planning with the business, it's not just a one-time thing where you come up with a document and you file it away and you're done with it. It's probably a process that takes a significant amount of time to put into place,
Mhm.
and then it is a piece of paperwork that needs to stay living and active because families change all the time, and we need to be understanding of the circumstances that everybody is involved with and the changes that are coming up to ensure that maybe that plan made sense a year ago, 3 years ago, 5 years ago. Maybe it's a horrible plan now.
Yeah.
So I think that's really important, and always bringing the various levels of professionals together to ensure that we're providing the best planning advice on a regular basis to the client. I think is very important.
It's the key.
For sure.
It's the key. And to not feel like as the client that is not that should be an expectation.
Right.
Because the financial plan I had 10 years ago, before I was married and had 3 children,
Right.
was very, very different. Very different
No
than
doubt.
it is today.
For sure.
And in another decade, when they're teenagers and getting ready to move out, it will be different. So it's knowing that it has to be flexible enough to change with your world.
Right.
And it should be all looked at very comprehensively from an estate, tax, and financial planning side, at the very least every 3 to 5 years. Because rules change.
Yeah.
Right?
Yeah.
The plan might still be fine,
Sure.
but there might have been a change in a CRA rule
Yeah.
that makes what we had not work anymore.
Yeah. That's a good point.
So sometimes it isn't necessarily your family circumstance that changed. Maybe there was a rule or a legal change that means we have to address it. but it needs to be nimble enough to manage, you know, trying to make a plan that's going to be good for 30 years is a good goal, but not going to happen without some changes
Right.
along the way,
Right.
which are good. That's
Yeah.
and you should be working with professionals that know that.
Perfect. No, that's good. So this last one we've kind of touched on a bit, but I think we could maybe get a little bit more out of it. So what should someone consider when they're deciding between the three types of accounts based on their goals and their situation? Like I know a lot of times clients will phone up, you know, late-ish February and they say, what do I need to put in that RSP to not pay tax? Okay, well, you could probably put in X amount of dollars, but you know, based on the bracket you're in, you know, you're putting in $10,000 to save $3,000 of tax. Does that make sense? You know, I don't know. Depending on the situation, maybe it does make sense. For me, I don't know, it's a lot of cash outflow for not a big cash payoff on the short term. So are there things that, you know, people should kind of take into consideration based on where they're at in life, you know, maybe short term versus long term? Like I know I've been advised, you know, as I'm growing my wealth, probably look at maximizing my TFSA and my RRSP before I even think about putting dollars into a non-registered account. Maybe that's just one financial planner's advice. Maybe there's better options out there. That's what I've been told.
Yeah.
What do you think?
And that's the most, I think, frustrating and challenging thing for clients
Sure.
is good accountants, good financial planners give the most annoying answer out there. It depends. I know everybody everybody
That's
hates
a
hearing it.
boilerplate. For
Yeah,
sure.
but it's really true because it does depend on a couple of different things. From a client standpoint, with your story of for yourself, right? Tax-free first, RSP second, third non-registered. That's giving you a good balance between getting a bit back today and having that tax-free deferral in the TFSA longer term.
Right.
If you are a person that is content and okay with swallowing that upfront tax hit,
Okay.
maybe it would be a good idea to do TFSA non-registered, RSP not so much. But you're front loading a lot of that tax burden.
Right.
You don't have any major deferral for later.
For sure.
And for some, that's just not palatable. But
Fair enough.
but then we are in a very privileged position, I have found, is many people did really, really well saving in their RSPs and all their investments over the years, and they're going into retirement and going, wait a second, why is my tax bracket not dropping?
Oh, okay.
Right? Because if you do max out that RSP all those years and you get some good growth,
Right.
and retirement at 71 or at 60, whenever you retire and start drawing out those RSPs, well, it's still going to grow for
Right.
another 30 or 35 years.
Right.
So it is finding that balance each and every year of going, am I okay with taking a little bit more of an upfront, paying a little more tax upfront to have less tax later?
Right.
You also then have to be okay with going, well, that money, even though it's not called an RSP, is for all purposes a retirement savings account.
Right.
That means it's not the Hawaii account, it's not it's not the new truck account. It
Sure.
has to have that same discipline around it
Right.
as if you did have a 30% penalty of withholding tax if you took it out.
Gotcha.
So that's the tough part.
It is.
That's I wish I could say yes, it's financial planner, I was better at it, but it's tough, right? That's the one good thing as you're working, that RSP, right? If if you're a business owner and you're making, good money, whether you're T4'd or self-employed, that whole idea of I have to go in and if I pull any money out of that RSP, I have an upfront 30% or 20% depending on how much you pull out hit, and then I have to bring it to Jared and go, I took money out and now I have to add extra income to my tax return. Does a lot to stop us from pulling it.
Yeah.
Is it always the perfect financial and tax move? Maybe not. But we don't. It's just finding that balance between those two things of going, do I have the discipline? Unfortunately, there's not really any way around it. The discipline to go, I will not touch that for 30 years, and I'm okay with going, I'm going to get tax slips on that money every year, forever and ever.
Right.
Because you do, right? On the interest, the dividends, capital gains, whatever it is, if it's in a non-registered, you pay every year.
That you do.
So, it, again, depends.
As always, it depends. But I think it's a good idea to keep these things in mind and keep in constant contact. And I think, like you mentioned before, you should expect these things out of your planner, out of your accountant, because, at the end of the day, and I always kind of bring this back to the analogy when I get new business owners in, should I hire a bookkeeper? Well, I say, do you know how to do any bookkeeping? Well, yeah, I could probably figure it out. But do you do a lot better job working in your business, making money at whatever it is that you do to make money versus bookkeeping? And I think it boils back to the same point, on the financial planning. Why don't you go out there, do your oil field consulting, sell your widgets, whatever it is that you do, take those dollars, and then have these constant conversations with your accountant, your financial planner, to ensure that your hard-earned dollars are working for you when you're not working, as opposed to trying to figure out everything yourself. Because, like you said, with the rule changes, things are always changing. Even as professionals, it's hard to keep up on everything because it's just constantly changing. So, as that business owner, if you can find that trusted, planning firm, you find someone that you mesh with really well, that you can, have these ongoing conversations, I think that's really going to be beneficial not only to you in the short term, but in, seeing that wealth transfer to that next generation, preserving your legacy over time. And I think at the end of the day, that's probably what most people want to see out of their dollars, is that, they're able to provide for their family now and then, going forward as well. So I think that's a good piece.
It's huge, right? That's what all of us want,
For sure.
I think, right? Is to be able to do all the things that we want to do, when we want to do it, and know that we're taking care of ourselves and our family and possibly our future family.
Sure.
We do know now with some longer term studies out of Canada and the US that working with professionals increases people's net worth, right? We know now that after about a 15-year span, net worth is 2.3 times higher working with financial planning professionals and accountants than doing it yourself, which kind of makes sense to me because I can walk into the gym all the time. I am going to get in better shape faster if I pay for a personal trainer.
That's fair.
So, but finding that person that you can sit across the table and have those conversations with and keeps it up to date and is always looking out for your best interest and tailoring it to your situation as it changes is the most important piece.
For sure. Perfect. So I guess in closing, is there anything else that you wanted to just throw out there as far as TFSAs, RRSPs, non-registered accounts?
No, the federal government added a new program that we'll have more information about over the coming couple of years, is the new home buyer savings plan.
Right.
to add to the mix. It is a hybrid between the TFSA and the RRSP,
Right.
but that will be for another day and
For sure.
another time. So, you know, it's just keep in contact with your professionals. Know that it's complicated.
Yes.
We have made finances in Canada, the Tax Act, all of it. It's not easy. So that's probably one of the most common comments I get after working with people for a few years is that they didn't feel comfortable asking questions at the beginning. And we do this all the time.
Right. Right.
I could not tell you the first thing about what to seed first in the spring.
That's
I
fair.
don't know. Don't have a clue.
Yep.
It goes in, it looks beautiful, it comes up, I know canola's yellow. Right? But my neighbor, that is an amazing farmer, knows it inside out and backwards. It's no different. Don't feel intimidated coming in and asking the questions. My favorite new client is when they come in, they've got their list, they're like, okay, here's what I need to know. Because it's a lot.
It is.
It's a lot, and it's going to take time. You're not going to build a financial plan in an hour.
I agree.
It's not going to happen.
Nope.
But having that person that you can phone, meet with, talk to, and go, why did we do this again? What's this for? Okay, so this just came up. What do we need to do to juggle it, to shift it around? That will be so helpful over the long term and even in the short term.
Perfect. No, that's good advice. I think being able to kind of take that first step, speak with a planner, you know, have that list of questions, coming prepared. I know that always helps when I have new clients into here. If they've got that list of items, if they want to know whether it's a new business or they're coming in to deal with something that, you know, has been on their mind, we can sit down and, you know, efficiently get through things and kind of get that next step. Okay, we've got this figured out. Let's get the plan, you know, moving forward and get everything working for you. So that's great. So I think that'll wrap this episode up. Colleen, I just wanted to say thank you very much for taking time out of your busy schedule, hopping on the podcast. I know you've provided a lot of great value to the listeners over the course of, you know, TFSAs, RSPs, non-registered accounts, lots of stuff out there. If someone's looking to get a hold of you, what is the best way to kind of touch base with you?
You can find me on LinkedIn. Just search my name, Colleen Gillam-Judd. I also have a website, juddwealth.ca, and you can find information on there as well.
Perfect. I will put all that information in the show notes, so feel free to reach out to Colleen and schedule that visit to start putting that plan into place. So for the Tax Talk Podcast, I'm Jerry Plon. Thank you again for listening. Take care, and we will talk soon.
Thank you.
That's it.
Perfect.
Right on.